It's not always smart to do that. But let me tell you something. If you ever have a desire to become a big trader, not just a mediocre trader, I mean a big trader, you've got to know when it's right to put the pedal all the way to the metal. There are moments where you have to play big, bigger than normal. And they are rare. They're not all that rare, but there are moments also where you risk it all. There are moments where you go to every single neighbor, every single family member and borrow money and risk their money too. Right? That's what we do in the hedge fund industry. We leverage and borrow against our own capital to play things even bigger than our capital allows. That's called leverage, right? So I call it the almighty kamikaze play. Now, it's based off the bottoming tail bar, which is what I just taught you or explained to you. The bottoming tail bar. I didn't create that. That's just something that forms, right? There's the bottoming tail bars fall into two categories: the regular bottoming tail bars and kamikaze bottoming tail bars. Now, regular tail bars are tail bars that form near a 20-period moving average. So every item we look at, we have a 20-period moving average on it. And if the bottoming tail bar forms anywhere near that 20-period moving average, it's classified as a regular bottoming tail bar. And we buy it aggressively, but we don't risk all on regular tail bars. We do buy regular tail bars aggressively, but we don't risk everything on regular tail bars. Then there's the kamikaze tail bar, and I'll show you many examples of this in just a moment. There's the kamikaze. The almighty kamikaze tail bar forms deep below the 20-period moving average. Not at the 20-period moving average, not near the 20-period moving average, but way below the 20-period moving average. And here's the key criteria. The space between the top of the tail bar and the 20-period moving average, there has to be a lot of space between the top of the bar, not the bottom, but the top of the bar and the 20-period moving average. And if you have that criteria, it's a kamikaze. And before that tail bar finishes, you empty your account into it. And you put a stop where? Under the bottom of the tail. By how much? 1 penny. Don't give it a filter, because kamikazes should not even flirt with the bottom of the tail. Do you follow? If they're really sound. Now, is this a regular or kamikaze? Here's the 20-period moving average. Is that a regular? Now remember, the regular tail bar starts at or near the 20. The kamikaze it forms way below the 20. It starts way below the 20. This starts at the 20. It drops. Now at the low, what color was that bar? When it was at the low? A fat red bar. Do you know how many people got stopped out at that low? And then everything was regained. The tail bar is a clean out bar. It gets rid of the last of the Mohicans holding on for dear life. And then when the comeback comes, they're left behind. That's why the stock can go. I wrote in one of my books, I said the market's like the bandwagon theory. Right? When too many people get on the bandwagon slows, and now the bandwagon that was playing music, attracting the people in the first place, can't go. So when so many people pile on to this party on the bandwagon, the music stops and the bandwagon stops. And then it starts jerking people off by going backwards, because the nature of the bandwagon is to go forward. But it can't, so it starts jerking people off. And then in one fell swoop, it lifts its whole self up and dumps as many people off as possible. When it comes back to the ground, it has very few people or no people left. Now it can take off. It must lighten itself before it can take off on its next run. This is the bandwagon dumping everyone off and now being light enough to go on to another new party. Does that make sense? The bottoming tail bar is that final kickoff of the last of the Mohicans. Now, we buy this bar toward the end of the bar's formation. We put a stop under the low, and we hold on. And I tell my traders, if the stock gets above the 20-period moving average, after several bars above the 20-period moving average, now you can move your stop, and your 20-period moving average becomes your trailing stop. Does that make sense? You ultimately can't keep this as your stop if the stock gets way up here. You have to now adjust it, and now you can trail the 20-period moving average as your trailing stop to see how far this party goes. Now, this is getting closer to a kamikaze. Why? Because it started below the 20. This starts at the 20 and drops below. This starts below the 20, but it's not a pure kamikaze because I want it to start way below the 20-period moving average. It's got to be extreme to be a kamikaze. So this is kind of a hybrid. I will play it aggressively. I will buy this bar before this bar finishes. I will put my stop there. My risk is right here. This is my risk. I bought toward the end of the bar's formation. My stop is here. I only risk this, but I risk it for that. Once we get comfortably above the 20-period moving average, I can start trailing the 20-period moving average. Now, just because a stock touches the 20 doesn't mean it's broken the 20. A break is a full bar below the 20, all right? Not just a blip below the 20, all right? So my trailing stop of the 20 keeps me in the play for maximum profitability. We buy into the bar. Guys, we don't wait for the next bar. We don't say, okay, well, let me wait for this to finish and see what the next bar brings. No, we get inside of that bar because the next bar might be up here like it did. It might be up here. All right? Now, here is also, it didn't form at the 20. It formed below, but I want the kamikaze deep below. So do I still play this type of bottoming tail bar? Absolutely. We buy into the bottoming tail bar, but I don't risk it all. I buy aggressively, though, with a stop under the tail bar's low by 1 penny or so. Once the stock gets comfortably back above the 20, I move my stop from under the tail bar's low to start trailing the stop with the 20. And blips don't count as breaks. And I'm still in the play. Now, my traders are taught that once you get into a play and it starts working, they must add to it unless they've risked it all. If you haven't risked it all, you have to add to winning plays. It's a must. All right? And I teach them one simple tactic to add. After you have bought, the first time you see a single red bar, this is a single red bar. If it's a single red bar all by itself, I want you to mark the high. And when the stock trades above the high of that single red bar, you add to it. So this is not entirely clear, but this is a single red bar. It's the first one. You do it on the first one. You can actually do it on the second one too, but the first one is key. This is your first buy, but the first add point is once the high of this single red bar gets taken out. Boom, there's your add point. We add, I call this the RBI, single red bar ignored. Now, if it's two red bars, no. It has to be only one red bar by itself, not followed by a second one. So here it is again. Here's not a kamikaze. It's still regular because although it started below the 20, dropped, and came back, it's still not deep enough for me to be a true, unadulterated kamikaze. But I'm still going to buy toward the end of this bar's formation. I'm going to put my stop under that bar's low. Once it gets comfortably above the 20, I mean, not just a blip above, like I like to see get above the 20. I like to see it kind of test the 20 out, like hit it a little bit, and then go back up. And now I start trailing on the 20. Now, based on my add tactic, do you see where you would be adding if you were one of my traders? You look for the first single red bar standing all by itself, and when the high of that bar gets taken out, you add single red bar all by itself, not followed by a second one. You buy once the market takes out that high. The reason for that is that that single red bar is now telling you that the bears have their chance. The bulls had their chance and produced this. Now, the ball has been passed to the bears like a football game. The bulls already had their touchdown. Now it's time for the bears. They get the ball, and what do? That's it? One bar? That's all you can give me? You're weak. You're going to lose this game. Does that concept make sense? That when the bears have their chance, they do diddly. It tells you how powerful the bulls are. So if their single bar gets taken out, we're going more with the bulls. Now remember I said you can do it the second time too. Here's the second time there's a single red bar. All by itself. The bears got the ball again. And they could only produce one. That's it. I'm going with the bulls even more now. I'm increasing my bet. I'm going to buy once the high of that single red bar gets taken out. And vroom, there's your rally. Now, once it gets comfortably above the 20, we're trailing our stop at the 20. Now, I want to show you something here. There are times we just don't sell if the 20 is broken to take profits. I like to sell above the 20. I don't wait for trouble to get out of my play. All right? So when the stock gets decently above the 20, meaning there's a lot of space between the stock's price and the 20, we start scaling out if it gets above the 20. See, stocks can get and anything that trades, stocks, whether it's futures contracts, options, it doesn't matter, currency pairs, if it gets too far above the 20, right, too far above the 20, it's not sustainable. So we take profits here. Now get this. Here's the Kamikaze. Look at all the space between the high of the bottoming tail bar and the 20-period moving average bar. We're going to buy toward the end of this bar's formation. Everything we have is going to get piled into this bar with the stop under that low. Now, when I say risk it all, am I really saying risk it all? No. Even though you put everything you have into that bar, you're only risking a part of it because your stop is there. But look at the space. Now look at this. You see, that space is the same as this space. The stock got a certain distance below the 20, and then it rallied and got a certain distance, same distance above the 20. So when the opposite scenario happens, we start taking profits. If deep below the 20 is a buy, way above the 20 is a sell. Does that make sense? It's just a picture upside down. Okay? Now here, Kamikaze, look at all the space between the high of the bottoming tail bar and the 20-period moving average. We buy into this bar, all we have, with a stop under the low. And there's our run. Now, look at this space. It's time to start taking some profits. If when a stock gets deep below the 20, it's a buy. When it gets way above the 20, it's a sell. It's just a picture upside down. Bottoming tail bars. Again, Kamikaze. Look at all the space between the high and the 20-period moving average. We buy into this bottoming tail bar. Everything we have, we put a stop under the low, and there's our move. Bottoming tail bar. Way below the 20-period moving average. A lot of space. Enter, stop, right? We flirted with it, never hit it. Now this could be a 5-minute chart, and that's over a couple of hours. It can be a 60-minute chart over a few days. It can be a daily chart over a few weeks. The time frame doesn't matter. This is applicable in every single time frame you trade. And it's applicable in every single market you trade. Options, currencies, what have you. All right? The tenets of fear and greed operate in all markets. Right? The initial drop of a bottoming tail bar is fear. But it's immediately recouped by greed. Bottoming tail bar. Is that a Kamikaze or a regular one? Excuse me? Regular, right? It's not deep below, but is it buyable? Oh yes, you buy all of them. It's just, do you buy are you dealing with a Kamikaze or a regular one? We're going to buy into this bar toward the end of the bar's formation, stop under the low, and there's your rally. Right? Look at The high, I'm taking some profits off the table here, and if I didn't take everything off the table, I'm taking some off the table here. Whenever, see, stocks can get above, but they can't stay there. They can get below, but they can't stay there. That 20-period moving average is an incredible overbought, oversold guide. Okay? Here, bottoming tail bar, below the 20-period moving average. You're going to buy into this bottoming tail bar, stop under the low. There's your move. The first single red bar all by itself, when the high gets taken out, you're adding there. You're moving your stop to the 20-period moving average. You're trailing. But now the stock gets so far above the 20, you've got to be thinking about taking profits off the table. Now, my 5-year-olds have this trading lesson every week of their lives. I started all of my children off at 5 years old. They know visually, they know as children, wow, Daddy, that's way above this line right here. It's time to sell. Wow, Daddy, that's way below that line. It's maybe time to buy. And there's simple, basic concepts like that. We make this game a lot more difficult than it needs to be by this. All right? You're listening to Kramer throw out 2014 symbols per hour. All right? You're reading this report on this website. You're listening to your friend who's saying he's profitable and is probably really not, and so forth and so on. We make it a lot more difficult, and we've got a lot more garbage that we're carrying around than we need to. Listen, stocks can get above the 20. Look at how far above, but they can't stay there. Stocks can get way below the 20. Look how far, but they can't stay there. My daughters know this. My twins, 5-year-old twins, they know this. We buy into this bar with a stop under the low. All right? And there's our move. Once we get comfortably above the 20, we simply move our stop to trailing with the 20. And if this gets too far above, you're looking to take profits. Take some profits. All right? Bottoming tail bar. It's a lot of space between the high of the bar and the 20-period moving average. We're buying into this bar before the bar finishes. We're putting a stop. Here's my move. Once we get comfortable above the 20, we move the stop from here to the 20. And once we get too far above the 20, we start selling into the rally. Simple but powerful. The issue here, ladies and gentlemen, is that I can't find. It's humanly impossible for me to find every single kamikaze and every single stock and every single currency pair and every single futures contract. But if I've got thousands of traders and I divide the market amongst the 5,000 and say, listen, here's your 10 stocks. Find every single kamikaze that ever forms, and here's the money to play it. And I give you 90% of the profits. And I'll keep 10. Just for doing it with me. And now we're a team. Now I can only find 5 or 6 or whatever. You might find 5 or 6. He might find 5 or 6. And no kamikaze goes uncapitalized on. Do you see where this dream comes? This is the master plan. All right? This is the master plan. Now, here are your next steps, guys. Your next steps are to email this and get this presentation under your belt. I want you to study it, and I want you to try it. I want you to track it for yourself. All right? You know it. Kamikaze, and it's spelled with an I. All right? Kamikaze at iPhoneTraders.com. All right? Please come visit our booth, because I do want you to talk to Chima, and I want you to talk to Dr. Dan, and pick their brains. I want you to also become a Facebook friend of mine, if you will. Thousands upon thousands of traders communicate with me this way. The best way to find me is just to put this URL in and to type in this URL, facebook.com/trade4wealth. And it'll go right to my page. Come friend, I accept everybody. Ask me questions. I get back to every single question and so forth and so on. It's just the best, most convenient way to communicate with you. You have a question on the kamikaze tactic or what have you. And listen, let me tell you something. If you are experiencing a multitude of losses with this tactic, you are doing something wrong. This tactic, the reason why I've named it the kamikaze is because it's rare to see it fail. Rare. Like once every 8 months rare, like that. It's rare. The third thing I want you to do, I want you to consider this. Let me train you. My traders get trained every day of their lives. Training should never stop. Now, there's a difference between education and training. Training is on the job when you are actually trading with an advisor trading with you. That's training. Training is what a doctor does after school when he's in a hospital dealing with sicknesses and dealing with patients before he becomes a full-fledged doctor. Training. Let me train you every day of your life. Let me fund you. Put your capital away. Why do the richest individuals on the planet trade other people's money? Why do the billionaires that have hedge funds open up a hedge fund to attract other people's money? Do you know why? Because they trade better when they have to answer to someone else. This is why very wealthy people in the industry still attract money to trade. Right? They attract billions and they have billions. Right? So we find that traders do better because you'll do stupid things with your money. But you will do fewer stupid things with my money because you will not want to disappoint me. And this is very true. So put your money away. Risk my capital. If I can't make you profitable, all the losses are mine. Now, who does that? Most people who are going to train you are going to pat you on the... After you finish eating their cookies and their soda in the back of the hotel room, all right, and you shake their hand at the end of the seminar, all right, and exchange a few pleasantries, they pat you on the back, and what happens after that? All right? Good luck. All right? But after I teach you, I say, now... here's my own capital. I believe in you so explicitly. I believe in my ability to get you there so explicitly. I'm going to risk my money, not yours, mine. And if you don't get it, all the losses are mine. All right? I'll absorb all the losses until you're profitable. When you're profitable, you will, and there is an upfront cost, so you will first recoup all of your profits. All of the profits are yours, or yours, or yours, until every dime you paid for the program up front is back in your pocket. Once you have gotten every dime back, now we're in business. I'm not totally stupid. I have to profit from this too. All right? So you get all of your money back first. Then we start splitting the games. Now we start to split it 80-20. 80 to you, 20 to me. And then it goes up for you. Then it's 85 at a certain level. Then 90. Then all the way to 95. I don't go beyond 95. All right? We're not 95. We're not going to get back to 100. But here's the thing now. Now this, guys, this is your business. Don't look at it like joining me. In a way, look at it as your business. And you have a money source that can go beyond your money source. So that if you get your skill up, but your money's not up, that's a problem too. I got the skill, but I have no capital. All right? I know how to bake, but I don't have money to open up a bakery. I know how to trade, but I don't have the money to trade big and support my family. I have the money for you. And I will make sure you do the right thing because, trust me, I am not going to let you lose my money. Not a lot of it. You're going to lose some of it first, but not a lot of it. So this is your trading business. Look, don't get spooked by the price. Equity or Forex prop trading team. This is the fastest growing area right now. The regular price is $10.99. All right, but if you pay for it in full, now remember, this is just up front. I've got to have a barrier to entry, guys. If I gave you this free, and the program really is free, but if I gave it to you free, you wouldn't take it seriously. You'd have a bad week, and you're like, forget this. But if you've got some skin in the game, you're going to really try to make this work. So here's $2,000 savings up front, but if just because you're part of this expo, we're going to knock it down one more $1,000. Here's $7,900. $8,000. Guys, you can lose that in a single trade, in a single week, in a year. All right? This is your one-bar stop. It's the maximum you can lose because you can lose for years after years with me. I never fire a trader. We just work with them and guide them. This is your one-bar stop. You can't lose more than this. And the rest of the program is free for the rest of your life. Free training every day. Free guidance under the tutelage of my top trading guys. All right, prop financing program. If you can't afford that up front, then start off with $4,500 monthly payments. But here, I'll even knock that down. The Expo special, start off with $3,000, guys, and then pay off the balance $500 a month. Now get this. You can stop anytime. Oliver, I'm going on vacation. Oliver, I need a rest, or whatever. And then resume the $500 at any time. There's no obligation. I got traders that trade 1 hour a day. They actually do pretty well, believe it or not. Or several days a week, or whenever they can, or every hour of the day. I've got them all. There's no obligation to trade, and we do this all online. But my system allows me to control your keyboard. So that once you hit your maximum daily loss on the day, your keyboard stops working. It's like, what the heck happened? And your screen goes blank. Boop. This is true. Technology allows me to do this with traders in Asia. I got traders in Asia, Latin America, and Canada, and Europe, and all over. All over. So $2,900, $33,000 up front, $500 a month, and you're in business, and your expansion as a businessman, so as you grow, you get automatic increased money supply. What business can you be in with this? This is the last batch in Total Independence. This is $115 per week. What business can you be in and also get your expansion funded as you get better? You've got to look at this like that. This is not a game. This is not croqueting. This is trading, and you can get to the point where you can make the $500 monthly payment through your trading. Now listen to this. Look at this very quickly. This is one of our Forex traders. He writes to Chima. This is the day before. When did he write this, Chima? What day did he write this? Well, I forget which day. It's two or 3 days ago. His name is Brian Lee. All right, Chima, hoping to take top spot in the challenge today. I have a $1 million trading challenge going on with my traders this month. So they started this month on a $1 million trading challenge. This guy is in second place. He says someday someday I might have to join you on the panel. Isn't $29,000 or up 190% in less than 2 weeks good? I'm so amazed, Chima. Last time in the last challenge, I looked at who was at number 1 and I thought to myself, there's no way that's a real person. That's got to be a trading machine. How can someone be that good? Now it's him. And number 2, he's up 190%. He's not even number 1. And it's 2 weeks in the program with 2 weeks left. Here's the challenge leaderboard, which you can actually track day by day if you like, if you know the URL. With a $10,000 account, number 1 is up $31,000 after 2 weeks of trading, 11/15. We go all the way to the end of the month. Right? This was the current day's trading gains, which brought him to 31,000. Or do I have this wrong too? Is this 2,000 plus the 31? Or does the 31 incorporate the 2,000? Dan? Right. I mean, does the 2,000 part of this, or do we add 31 and 2,000? All right. Right. So he's up $31,000 in 2 weeks off $10,000. Right? That's incredible. That's a 200+% gain in 2 weeks. All right? But second place is not bad. 30,000, 20,000, 21, 21, 21, 20, 19, 18, 18,000. These traders rock. All right? Now here's how to get the program free. As I told you, 100% reimbursement. No, we do not take any of your profits until that $3,000 you put up or that $7,000 you put up is all the way back in your pocket, and then we start the split. Here's our latest. Cornell Montanou was the latest person to get 100% of his tuition back. $69.95 is what he paid at that time. All right? And he's slated to receive that on the 18th, the check. Here. So let me train you guys. Listen, this is not about your educational fee. This is about the global dream. 5,000 funded traders profiting every hour in every market. It's about this being duplicated hundreds of times. I want traders doing this. I want traders doing that. This is a much bigger game than your educational fee. So do me a favor. Visit our booth. Talk to Dr. Dan. Talk to Chima. Talk to Demetrius Wright, our Director of Admissions. Talk to Jay Fry, our Director of Wealth and Options. Pick their brains. Ask as many questions as you like. Shoot, watch them trade. I think they even will trade from here as well during market hours. All right, if you're in internet land, email info@iFundTraders. And thank you very much. Was it helpful? Thank you so much.